Okay, cool. And you can still hear me. That's a good thing. All right, I'm not going to change anything now, so we are just going to carry on with this, and I'll move everything onto the one window that seems to work. We'll have to find out exactly what went on there. Um, okay, hi everyone. Let's start the webinar here, shall we? Um, we're going to go over tonight very quickly some of the new changes that have come into the system in the last couple of weeks. And sort of a lot of it was bubbling away in the background, so you won't necessarily notice a lot of stuff going on, but there's a fair amount under the hood that we were doing in preparation for some of the new features we're bringing in the next couple of weeks. So they should roll on quite quickly now. Um, so the initial things that we've done on new features, just looking at the watch list portfolios and screeners, we've added in some categorization now just to make it easier to find a way around. A lot of people, myself included, are starting to get a huge number of watch lists and portfolios or screeners and things like that you very quickly become lost. So we thought we'd just restyle how we're showing this stuff. So we now have the categorization of my and my stock scanner, and also others when that starts becoming available in the future, when people start sharing their watch list and portfolios and screeners going through. So watch lists, you can see sort of just everything's categorized. We've smartened things up a bit and just on the screen. Portfolios in a similar way. Ignore the 1 month at the moment. I had fixed a bug there. These aren't actually 1 month figures in there. I don't know what the figures are actually. I think there might be a 30-day rolling average, but they're not correct at the moment. Um, and on the screeners, we've also added in, we got rid of the boxes because a lot of people were saying to us, it's just very difficult to navigate. Hans Henrik was one of them actually just saying, can we change that? So I've moved them around and just actually come up with just different categorization of mine, my stock scanner. When you are in there as well, one of the options we've added is the ability to go in and add your own categories in here. This is just warming up the screener. It's the first time it's been used for about 5 minutes, I think. So when you're actually editing here and editing the screener name, you can now select a category. You can either make it, I think by default they come in as uncategorized, but now you can actually add a new category in there and then save that as well. So that can be, let's call it test for now. So when you save that and go back to the screener, you'll see the category of test now in there. So we've got a few users that have got literally sort of 30, 40, 50 different watch lists, and they will find it very difficult to start navigating around. So that's why that's in there. That is the first sort of change that's gone on. The second change is on the portfolio following. So if we go on to quality momentum, probably a good idea. We can now see there is one button. You won't see this button. I'm in as an administrator, so you will see an alert me button here that you can then press, and then any time that we make changes to the portfolio, we then know that you want to be notified about this, and we actually have an option to put in details of what's changed and so on and so forth, and send you a quick message. So anyone who's following this stuff, especially the monthly rebalances, they're pretty simple to do because everyone knows on a monthly basis they're going to rebalance. We send you the spreadsheets. That as we start getting into more maybe slightly quicker turnaround strategies, maybe some swing trading, also some longer term strategies as well, which we may be looking at 6-month holding times, then that's going to be a useful thing for you to be able to follow this. So that's going to become more and more useful as we go forward, and some of the changes we're putting in place in sort of the next couple of months, but we'll talk about that at the end, hopefully. We've also implemented the Learn section. That's been here for, I think, 3 weeks, something like that. So we've got a mixture of webinars, which we haven't actually got any webinars on there at the moment. We're going to be loading that up probably over the weekend, I think. So all the historic webinars, both the members webinars and all the open ones that we've done, will be on here. So it's nice and easy for you guys to find. We've also got a list of the we've got a couple of webinars on. We've also got any blogs on there that and one of the implementations, one of the new features we've got in here is to start bringing more text onto the system rather than just the videos. So we'll start doing that as we go forward and adding some more textual content. You can also see that we've added a course section. We're going to start adding in a series of courses here. Will be geared really sort of steered by you guys on the kind of content you might want in the system. So things like we've got our 3-point playbook course, which will be on in the next probably over the weekend, the same time as the webinars go on. So that's a mini course that sort of takes you through the basics of identifying quality stocks, working out what their value is, and then timing the buying and selling of these things. If you want to go down to basics of what is a stock, what is a dividend, how do you buy, and things like that, we can go down there. And if you want to go higher up, there's going to be sort of more and more complex course contents and mini courses that we want to put onto the system. But again, if you guys have got any ideas on this, and something you particularly want, or something you feel we're not doing particularly well, please let us know, and we'll do some courses on them and actually give them to everyone so they can see. The 3 courses on there at the moment, we've got the 60-second help videos, which show when you're a new user, they show the first time you go into a page every time. So that just gives you an overview of each page that you go into. When you also have the dictionary of investment terms, so that is effectively every single term that we have on the system. We have some explanations on what they are. You can access this from here, or you can also access them from let's go into one of these from here. If you want to see total revenue, it will also come up with the same information there. So it's we worked quite hard in the last few weeks on actually putting this glossary together, and it seems to be working pretty well. And so we've got, I think it's about 250 different terms in there, something like that, with sort of some quite in-depth detail about the strengths and weaknesses of each point. So we're getting better on the help text. The next stage is I'll talk about that in a second. And we've also got how to use my stock scanner, which are more in-depth videos that have been completely revamped for the system. The videos were about 6 months old, so they were getting a bit out of date. We've really come in and tried to refocus the content on what you guys actually want and the questions you've been asking us over the last few months. So again, they're in various different themes. You can see finding stocks, from searching to building your own screeners to tracking watch lists, looking at stock information, how to use the TPI indicator, and they're longer this time than before, and often they're in 2 or 3 series. So how to value stocks, how to value chart, how to use the value charts, and then advanced use of the value charts are all in there, so that they're longer. Also, what you might have noticed is the system now caters for English and Danish. If you spot any ridiculous spelling mistakes or ridiculous terms, I will totally blame ChatGPT for the and Hans Henrik, actually, who checked some of them. But if you do spot any bad spelling, anything that looks ridiculous, we changed a few bits and pieces that Hans Henrik has noticed. But please just let me know, and we'll get those changed. But they're nice and easy. So on the courses and on a lot of the screens going forward, you can actually either say, I only want to see Danish content, or I want to see only English content, and so on. You can change your settings nice and easily by going in and just changing the language in here. So if you get any problems, as I say, let me know, and we'll put a fix in place. Um, that is that. I thought I would go over a very quick review of our portfolios because we're getting to the end of the month as well. They've done pretty well. I don't know what the average is. I think the average the other day was about 4 or 5%. So if we go through sort of the automated strategies and also the stock of the day strategies, we've got a return this month of 3.8%. So we've sort of come up from the doldrums of last month, where we took a bit of a beating on most of the strategies, all of the strategies, I think, and we're back up again on this one. We're sort of seriously beating the market on the quality of momentum. It's this, as you know, is a combination of quality and momentum scores here. So it's stocks that have been doing very well over the last 3 and 6 months on a price basis, and also they're high quality stocks at the same time. So not a bad combination all in all. And you can see actually a couple of additions. We've also got portfolio beta and alpha now. We can go into more depth on what they are in a later date, but very quickly, beta is effectively how much the portfolio moves for every 1 point move or percentage move on the underlying benchmark, which is the equal weighted S&P 500. And the alpha is the excess returns that isn't sort of given to us by the benchmark as well. This, Mikkel, we are going through because it's the end of the month. We've only got what, 4 trading days. Mikkel's just asked a question saying, "Are we going right through this now for everyone, or is this just for paying members?" Normally, certainly at any other time, we generally go through these at the just with the paying members. We're showing you guys and everyone this right now simply because it's the end of the month. I won't show the positions on here, but you guys can see this anyway. If you're not a paying user, you just can't see the positions, but you can see the whole portfolio and the returns. The TPI portfolio, again, it's up 5.1%. It took a drop of 7.7%. It's potentially because we buy at the bottom of a downswing, and we're expecting that the stock is statistically more likely to go up, then when you get a big hit to the market like we had in April, you can get some big swings in the TPI portfolio, and the same with the momentum portfolio as well. So we took a bit of a hit in April, but to be honest, the stock, the portfolio was already up anyway. So we'd already earned the money to take that beating, and now we're back up again as well. So it's recovered quite nicely, and again, sort of the total return 7% at the moment, so we're beating the market on there. The sector allocations on there, surprisingly, a lot of the we're heavy in tech and heavy in healthcare. We're less heavy in technology than we were a month ago, definitely. So that was an interesting shift away from where we were before and where the heat of the market was effectively. On the value momentum, again, we've come up 5%. We took another beating in April, but this strategy is really sort of going fantastically. We're up about 12.5% this year so far. So we're very pleased on that front. Again, this is very technology heavy, and also healthcare. They tend to be sort of the leaders in sort of the risk on, certainly have been for the last year or so. And lastly, on the automated portfolios, we're up 2.3% on the value quality. Tends to be a bit more of a slow burner, definitely. But again, we're beating the market on that, and much smaller sort of allocation to technology and healthcare in there than anywhere else. Very quickly, stock of the day, we're doing pretty well again. We're up 8%, so almost on par with the average of our portfolio, our automated portfolios. And we're not massively invested at the moment, simply because, and we'll see this on the screen as in a second as we go through, most stocks are incredibly expensive. I'm sure you're finding this as well at the moment. So it's difficult to find something where you think, yeah, there's some value in there. You got to look really hard. So that's what we're finding on the stock of the day portfolios. And then on the Nordic one, it's fairly recent that we've started that, so we're 3% up, just trading the market. But again, we're only, what is it, 40% invested. So actually, if we were 100% invested, then that would obviously be a little bit better. But keeping our powder dry right now for an improvement in the valuations of stocks. So that is a quick portfolio review. What I'll do as well, I thought it was interesting that the webinar, I save the stocks that I talk about in the webinars that I do. I hadn't realised it's over a month since I did my last one, but uh, we talked about these stocks: AMD, Google, Amazon, ASML, etc., etc. You can see them on there last month. I suddenly thought, actually, I don't know how well they did because I didn't track them. I bought a couple of them on there. They were actually up 6.6% on average. Big winner was Vertiv Holdings, which actually wasn't me that found it. It was Bent Larsen. But that was a stellar 27%. But the others, we had two losers. Everything else was a winner. So it was a good return from there. We probably hit the market quite well as well because the market had taken a dive. It was still diving by the 18th, but a little bit after that it started turning. So that probably helped a fair amount as well. But it does also show the power of our stock selection of the 3-point playbook that we're pushing forward as our sort of simple, in a nutshell, way of selecting stocks. We got a couple of things that we wanted to go through today on the watch list. First of them, we'll do some stock analysis in just a second. But the first thing we noticed, if we look at the big tech, so the top companies, these are the Magnificent Seven that raised the market last year by whatever it was, 40%, something like that. So these stocks were pretty much 100% responsible for the rise in the S&P 500 and the Nasdaq 100 last year. They make up about 42% of the index, which is why because they had such a stellar run, that's how they affected things. If you look at all of them, we were just going through them today. From a valuation point of view, you can see that Google, the analysts think that they're going to return -5% over the next couple of years. That's not because they're a bad company, it's because they are hugely valued at the moment. We'll come back to our own thoughts on that in a second. But if you look at Apple, a -3% return expected just by the analysts, not by us necessarily. Amazon, you got 14%, they're doing pretty well. Meta, you got 10%. Microsoft, you got 2%. Nvidia, 10%, and Tesla break even pretty much. What's interesting in that, and Hans Henrik and I were talking about this earlier on, is that actually the market is very, very toppy at the moment, where it's hugely expensive for a lot of stocks, and there's not necessarily a massive amount of room that the analysts are looking at to be able to go up in value. That's what the analysts are saying. But if we look at a stock like Nvidia, which is gained, I don't know what its gain is at the moment. It was 10% earlier on, but you're effectively looking at the potential growth from here on the analysts up to here, 1052. That is based on a PE of 32 in 2 years' time. Now, when we look at the averages on here, we can see that Nvidia is currently trading at 80. In the last 5 years, it's traded at 71. In the last 10 years, it's traded at 51. So with the current market as it is, with the AI frenzy, for it to come back down to 32, we look at that and we think there's not a chance it's going to do it, unless there's a massive issue in the market. Suddenly AI doesn't work anymore, companies aren't interested, people can't make money out of it, or things like that. So we see the valuation as pretty light from the estimates, from the analyst estimates. What we're looking at is the potential of saying, okay, if it drops down from 70, 80 as it is now down to 45, then we're still going to see a potential of 53% rise in Nvidia over the next couple of years. Hans Henrik produced a video today where he said pretty much the same thing. We're generally in agreement on this. He thinks probably more pessimistically about this than I do, on the whole AI technology side of things. If you look at just a PE of 50, all of a sudden you're up at 71%. That's 30% a year on the annualized returns. So this is just an indication that a lot of the time when we look at analyst estimates and they say, okay, in 2 years' time, our price target is X, and the PE therefore is 32 in this case. We look at it and we think, yeah, okay, you must be massively discounting that. So is there an upside to that? And that's really where Ben Larsen came in with VRT, with Vertiv Holdings last month, which is probably the biggest performer we've seen to date on from sort of the webinars that we've been doing. He looked at it and said the PE is just completely wrong. If the estimates are pretty much the company's meeting its estimates and they're hitting their targets, but the PE was so wrong that actually it only had one way to go, and that was up. And that's the kind of thing that we look for. So Nvidia is a good candidate for that. On the other side, someone like Tesla, probably not. To us, it looks pretty toppy, and we wouldn't be surprised if it comes down to 32 or 42, which would show you a loss of a decent loss, 25%, 22%, something like that. So that's where we look at the other way and think, well, actually, the analysts, if they're saying that this is going to go to is going to be at 54, and I think it's currently 42, what's the catalyst for Tesla to be able to up its PE all the way up to 54? Why are investors going to pay 54 times earnings to buy a car company effectively, when other car companies are only paying 8 to 10? For General Motors, for all the others out there, they tend to average down there. So we look at that and think there's probably only one way to go for that, for Tesla, and that's probably downwards. The interesting case here is actually Apple, where they're looking for a catalyst they need to sell more. They're not coming up with any new products out there. They're not innovating that much anymore. The iPhone, very famously, Steve Jobs' daughter, said, "Oh, here's my new iPhone," in the last release, and actually, oh no, it's not. It's the previous version, because they look so similar. The catalyst that I can see there that's come out of the last few weeks, last couple of months, is AI, and I think I mentioned it on the in the members forum a couple of weeks ago. Apple, what they're looking at doing right now is putting, and all the manufacturers, Microsoft came out with a press release this week about their Surface PCs. They're putting a mini version of an AI on the computer itself. Microsoft has just announced a deal with Qualcomm, so they could be running on their processors for their AI. Apple will be coming out with the same sort of thing. I think they already did that with the iPad release a couple of weeks ago, where they're using one of their new chips on it. So what's going to drive Apple's potential sales in the future, in the next 1 to 2 years? To me, I think that could be new iPhone sales, because people want to jump on the AI bandwagon. They're already talking about redeveloping Siri and Alexa and Hey Google and those sort of services. If they can get it right and actually they can show some real benefit, then that's the game changer for Apple, pushing their product further forward. However, there are some huge risks on that, and they haven't really delivered particularly well in the last year or so. So you look at that and you think, actually, there's more downside to upside. So yeah, even though they could get up to a PE of 34 if they start selling more product, and where are they now? Let's have a look. They're currently at 31, and the analysts think they'll be at 28. Which isn't, it means that they're pretty much break even. So that's sort of, that's my take on Hans and I's take on the big seven right now. If we jump very quickly onto some stocks, some new ones that I've been digging out of the market. One of them, one of them, Hans Henrik's just texting me. One of them I mentioned this week or last week, I think it was, which is Supermicro, but we'll go through them very quickly. I'll go through the basics as usual. I know a lot of you have been on already. You've been yeah, you've been through these webinars before, so you know how we do things and you know what we look for on the system. But from some of our newer members, I'll just go through very quickly, sort of on each of these, what we're looking for on the various different stages, on the three different stages of our 3-point plan that we follow. So effectively, number one question is, are we looking at quality stock? Now, there are various ways of looking at that. The obvious way is to look at the quality score, which very successfully in the last 23 years has picked out quality stocks that are that tend to go up in value more than the non-quality stocks and lower quality stocks. All of the scores are out of 100, so 100 being the best in the industry, in the country or the region that they're in, and 0 being the worst. You can also see 2 readings right now. These will get extended as we go in the next month or so, but you can see the country quality score and also the region quality score. With the US, that pretty much covers the whole of North America, but you've also got Europe out there, South America, etc., etc. I'll talk about where we're going with these in the future. At the end of the webinar. But what we are looking at doing when we look at quality stock is, as well as the quality score itself, we're also looking for some of the metrics and making sure that they're all looking good. So I tend to look for things like sales that are going up, which is one thing, but also more importantly, earnings per share going up. That's sort of part of the quality, how the quality system is built, the quality score is built as well. But seeing the growth and actually looking maybe at a chart to see how these things are going up and how rapidly they're rising is always particularly useful. So in here we can see the sales growth is great. Very, very strong. If we look at it, it probably looks better on a chart, so we can see it's sort of going up exponentially. Earnings per share is definitely very strong and going up, and forecast to go up as well. So it's forecasted to go up almost 100% on here. So a very good marker there. The quality returns that we can see on the company are also heading in the right direction. These, depending on the industry and the sector, the return on assets, what's acceptable as return on asset, return on capital, or return on equity line changes. But for this one in the aerospace and defence, they don't have great margins sometimes, but they are actually heading up and they're heading in the right direction. When you look at the theme of the aeronautical and aerospace and defence, every country, and certainly in the UK here, there's a big debate about it in politics on just how much we should be spending on defence. Every country's doing that at the moment in Europe, looking at Russia and NATO, and actually, what's an acceptable level of defence? Where are we at the moment? How far are we away from that? And I look at that and think, well, there's a big spend coming from most of the countries that companies like Axon are going to benefit from. It doesn't pay a dividend right now, it looks like. I haven't actually checked that one, to be honest. But also things like free cash flow per share, that's how much cash the company is actually generating and coming in, is going in the right direction. So that's great. Gearing is okay. The gross gearing, net gearing isn't that great, and the interest coverage is fairly low on the LTM side of things, but 22 times on the last annual report that we got. So not too bad there. So it sort of just about passes, I think, on certainly on the high level quality metrics that we look at. Next stage, once it passes that question, second question is the company fairly valued? And you can see here again, let's go through the basics very quickly on the value chart. These points are basically where the price should be at the various PEs that we specified here. So we specified the analyst PE at 60, and we've got 65 for our base case here. They're the only ones we've got shown at the moment. So effectively, if the price was to adhere to the PE of 60, it should be down here. So to us, just generally, that looks is it overvalued, or is just the PE too low, the prospective PE too low? It's probably the prospective PE is too low for the current price. When we look at the historics, we can see the PE, yeah, I was right, is currently at 123. Historically, it's been at 65 for the last 3 years, and I think we'll ignore those as outliers for 5 years, 10 years, 20 years. But the PE ratio has been very, very high. So people have been prepared to pay an awful lot to buy Axon shares. You can see the analysts think that the PE at the end of this year is going to be 77, and the end of next year, when the company announces results, is 60. So again, we look at that and we think, well, the 3-year average is 64, so that's probably not too bad. So we've got a 65 PE, and we're saying, if assuming the estimates come in as the analysts expect, then you can expect the price, if the PE is 60, as the analysts think, the price will go up by 21% in between now and about a year and a quarter, something like that, in January 26, year and a half. If the PE actually goes up 65, so it's slightly higher, you actually see a 30% return there. So it's very simple maths. We're basically taking the earnings per share times the PE. The PE ratio is how many, the investor appetite, multiplying the two together, and that will be the share price at the end of it. So if we get those two estimates right, we've got the share price right. Then, from my point of view, the way I always look at it is, I now have to justify, is the company going to make these earnings per share? Are they going to really double their earnings per share this year? And are they going to increase it by a further 26% in the second year in 2025? Okay, we can look at that. We can look at the fundamentals. We can look at the earnings reports. We, Hans Henrik and I, use Seeking Alpha. We use Market Screen. We use various other sources to look at sort of the future potential. Seeking Alpha is very, very good a lot of the time, because you get some quite good analytical analysts, which sort of sounds like an oxymoron, but they should be analytical, but they have quite a high bar, quite a high editorial bar to get content onto the site. So they tend to be pretty well thought through, and they come at things from an angle that maybe you don't think of. And the second thing is justifying the PE. So the PE to us is investor appetite. If investors suddenly think the company is going to go to the moon, they're going to be willing to pay more for it, and that shows in the PE ratio. And we can see that actually we can change the estimates by, I don't know, 15%, something like that, 20, 25%, and the stock moves slightly. But if we change the PE ratio by about the same amount, the stock shoots up even higher. And the PE ratio tends to be a bigger dictator of the price moves than the earnings, because the investor appetite is easier to change over time. So we think that Axon probably pretty well valued. If you think 21% over the next year and a half is acceptable, yes, I would say so. And will it go lower than that? What are the risks? That's what we've got to look at, and that's where a lot of the time we put in a base case as well, to say, okay, if the company still meets its estimates, but the war in Ukraine is suddenly disappears. We get a winner, or there's a massive stalemate and everyone decides to go home. Whatever, and people decide they're not going to gear up as much. Where would that go? Where would that take the PE? That could mean that it goes down to 45. In which case, if that's the case, we're going to lose 5.3% a year on that. Probably for the benefit, it's probably not a bad place to be, but that's sort of your own personal decision after that on the valuation. When the next stage, if we think the company's valued correctly and or undervalued, then we can go to the TPI to time these things. So the TPI, again, I'll explain it sort of very quickly. It's an indicator that Hans Henrik and I developed over the last couple of years that statistically tells you whether a stock is likely to go up or down. There are three parts to it. You've got the trend, which tells you whether the stock is in an uptrend or a downtrend. We only buy when the stock is in a green uptrend. The weekly trend and the daily trend are pretty similar, where you get various different states. You get the stock is going up, so it's in green. You can see it's in a nice trend here. It's a nice trend down here. turns to red when it starts going down or sideways. Um, and on the turning point, you get the grey bar at the top or the yellow bar at the bottom to say that there is a likelihood that the stock is going to change direction. Um, that's the same on the daily as well. The weekly is on a weekly series, so it's a lot slower, but you tend to see the effects, and the time it spends within the green or the red is a lot longer. The daily is on a daily basis and tends to change quite quickly. So depending on what time frame you guys trade on, you might want to use all of them. We've got a triple green screener on the system that's available to you, that has very good results. We'll post the webinars on that. I think it showed, I can't remember, somewhere between 16 and 18% a year for the last 23 years if you'd have chosen every single stock with a triple green with a couple of other rules in it that we tell the members about. Then it's a good winner in there. Personally, my trading style, because I trade a slightly longer time frame, I tend to look at the trend and the weekly, and maybe be guided on the exit by the daily, but I tend to sort of just use those two. Also, the stock turned into a red last on the TPI last week. What we're seeing here is we sort of forecast that if the stock stays as it is in the current price that it is last night, which was here, then the TPI should show it going into oversold, in which case it's likely to turn up in the next week, 1 to 3 weeks. So that's how the TPI works. If we look very quickly at some charts, we can see Axon. This is the weekly chart on the left, daily on the right. Not particularly pretty here. After earnings, it's come down a bit. Earnings were not too bad from what I could see. So I think people were taking profits from here, especially as we had this big bar coming here. So actually, from a TPI point of view, we might sort of look to buy, but actually that sort of steepness of a correction, I'd want to see it coming back up before we seriously consider buying this. So Axon's an interesting one. So out of the three questions, yes, it's a good quality stock. Yes, it's valued pretty well, especially now with the more recent sort of dip that we've had. The third question is it time to buy? TPI says it could be. And in which case you could see this starting to swing back upwards again. I would like to see some confirmation of that, maybe getting some higher highs and higher lows before we actually take it. But yeah, it looks like an interesting one to add to the watch list if that's your thing. We'll go through the others sort of pretty quickly, because we'll just go through the question, rattle through the questions sort of one by one. Question one on ChampionX. It's I believe this one's a chemical company. Yeah, it makes chemistry solutions for oil and gas companies around the world. So we can see a quality score of 90, a momentum of 53. It's been so you can see it's sort of fairly flat over the most recent period, and a value score of 61. The key one here is a quality score. We are looking at sales, which are going very nicely in the right direction. Probably we've had some pretty good gains over the last year, bit of a loss this year, but from an earnings per share point of view, we're going in the right direction as well. So we can see we had a loss in 2021, almost certainly down to COVID, I would guess, up there, and we got the EPS sort of steadily recovering and coming back up. When we look at the other quality metrics down here, we can see that we're producing great return on equity, great returns on capital here. So that's great. The dividends are covered very well, so we're not having a cash issue or anything like that. We're generating cash per share, which is pretty good, and actually, yeah, it's better than it has been the last 6 years or so. And also the debt is manageable, and the interest coverage is manageable as well. So we're 9.7 times the debt payments back there. So yeah, quality company. Looking at the Petrosky score, it's got a health score of 7, and the analysts have been downgrading it recently. I couldn't find much about why. I think they're just sort of yeah, it'll be an interesting one to see where that goes. Reporting earnings in 31 days, which could be why they're reducing their earnings, so that because the company often just before earnings will actually reduce down what what they're saying to analysts. So yes, answer to question one is yes, it's a quality company. From a valuation point of view, the analysts think it's going to return 33% in the next year and a half or so. Um, which is a pretty good basis to start. So they're looking at a 25% increase in earnings per share this year and an 18% next year, and a PE of 19. We think that actually looking at this, current PE is 21. It's been up to 31 before, 29 before, and next year, or the end of this year, the analysts are thinking it's going to be 22. So if we just plot in the 22.5, we're looking at a 57% increase over the next couple of years. So ChampionX looks like it's actually pretty undervalued at the moment. Even if it hadn't sort of dropped in the last month or so, then we still would have it still would have been undervalued. So this, barring any, we need to research it a bit more and look at sort of exactly why this drop has come out, just to make sure we're not missing anything. But it looks like a strong contender. They're currently in legal. SLB Schlumberger have bought a company off them a few years ago, and they're currently suing them for fiduciary misfeasance, I think they called it. Ironically, the stock on the day that the lawsuit got put against them actually went up, and it carried on going up for a little while. I think it came out mid-March or something like that. So that's certainly not the reason that that the stock has dropped that I can see. So it looks like a good value of a company, and the analysts certainly don't seem to be worried about the lawsuit against them. From a TPI point of view, we're in a nice uptrend on the weekly trend. On the actual weekly indicator itself, we saw it was oversold, but still in a downtrend. Now it's going sideways, slightly up, and now it's still oversold, but it's in the buy zone as well. We had a big drop yesterday. Not actually sure what that was, but again, that would be something that I'd want to look at a bit more. But this looks like a pretty good buy right now for my portfolio, certainly. Again, depending on your timescales, it's a decision for you guys to make, and with the caveats, looking at some more, getting some more data on exactly why this drop came out and why it's been going down more recently. If we look at the trading view side of things, this doesn't look pretty. So again, I'd probably want this to be broken and it come up to be above here. So actually, from a timing point of view, it's possibly not the right time to go. And the TPI is basically telling us that yes, there could be a good upswing coming up. And from a high point of view, it's still technically in an uptrend, so it hasn't actually broken sort of the major uptrend that's been going on for the last 3 years, which is good. That is CMX. Third one that I found today is Signacor. They are a healthcare provider in the US. I think they're worldwide as well, but they're reporting earnings soon as well. Not the highest quality company. It looks very grey and boring over here, but 60 is still not too bad. But what caught my eye on this was actually they had hit a negative EPS growth, but they're actually bouncing back 64% this year, according to the analysts. So that's not a bad sort of return on there. So the EPS growth itself has been quite high over some years, but it's not stellar. It's not perfect, but when you back that onto their revenue as well, which has suddenly shot up and has carried on going up as well, that looks pretty healthy. From a return point of view, returns sort of aren't fantastic, but 11% on return on equity, not too bad, but there might be something going on within the company. So I'd want to research a little bit more on exactly what problems they're facing. I think I suggested this in the last webinar as well, and I think this is one of the fallers since then. So it's something I'd be a bit more wary about. But dividends are covered very, very nicely. The other thing that really caught my eye was it's basically a free cash flow machine. This company generates $34 of cash for every share that is out there. So that tends to be a massive sign to me of a quality company. And are the debts manageable? Yeah, the cash to assets is not great, but it's always been down there. I think the whole industry tends to be like this a bit. And they have cash, and the interest coverage is okay at 4. It is, it's lowest it's been for a while. So another thing I'd worry about slightly. On the valuation, so quality company, yeah, I think it scrapes in just about as a quality company, mainly on the free cash flow side of things, and the revenue is heading in the right direction. On the valuation side of things, the analysts like it as well. They're saying there should be a 16%, in their opinion, 16% return over the next couple of years. And where are we? They're reporting January or end of the year, so we're halfway through the year already. So we're talking about 16.6% return in a year and a half. They estimate that the company will increase by 64 and 13% over the next couple of years and end up at a P at 12. I don't see that. I think that's undervaluing the company on their averages. So if you look now, we're trading about 19. Over the last 3 years, we've been at 16. 5 years, 14. The 10-year average is 16. To get down to 12, you've got to go below the 20-year average of the stock. So unless there's a problem that I haven't seen, or we dredge up in a bit more in more fundamental analysis, then actually saying that the PE in the best case will slip down to 17.5, or at a base case go down to 14, which is the average for the last 5 years, then we get a return on our base case of 36% over the next 2 years. Or if we're right on the bullish case, and the investors still love it, then you could see a 67% return on Cigna. So again, yes, the valuation looks pretty good, and pretty undervalued, based on the fact that there aren't any gotchas on the quality sort of side of things when we look more into that. TPI, it's been in a long uptrend for quite a while now. It went into oversold on the weekly, but then quickly turned around again. So you can see here that it was going down, went into oversold, went to green, went to oversold again. So it's sort of swooned a bit over the last couple of months. But we're now looking at TPI again, telling us that yes, it should be going up. If we look at the chart on Cigna, again, long-term uptrend from last year, middle of last year in the weekly. And again, we're in an uptrend from December as well. Might have been broken here. When we look up this way, potentially. So again, we need this to really turn around and start going up, and the TPI sort of hopefully is showing us that yes, this could be a time when we'd sit here and wait for the price to tick up above this level and break the resistance, and that could be an interesting trade. MLM, I'd never heard of this one. They make outdoor materials and basic materials in the States. Just in case you guys have not seen it, there is a description down the bottom here. I'm gonna make the text larger because it's always very, very small and very difficult to read, but it might be my age coming in there. But effectively, it's supplying the building materials industry, and they've got a very high quality score. The value score is 31, which I was quite surprised at, because I sort of expect it to have dived a bit since the value scores are quite low. When we look at the things like the revenues going quite healthily up. We're looking increase in earnings per share. Last year it was 35%. The analysts think it's going to be going up 16 and 12% over the next couple of years. So again, pretty good. The PEG ratio, which I haven't mentioned so far, we tend to look at that, which is the PE ratio adjusted for the prospective earnings or the growth in earnings over the next year and 2 years. So that's 1.2. We generally look to be under 1.5, maybe under 2.5, depending on what the industry is. The return on assets, capital and equity are great. So you can see here at the end of last year, their reporting period, they had 14.5%, 11 and 7. Pretty good scores, and all heading upwards as well. So the business is getting healthier and is getting more efficient at generating cash. Dividends covered really nicely. Again, bit of a free cash flow machine, and it's jumped up from 2022. So another thing that I always look at from a pure quality point of view is just how much cash is it going to generate for every share that I buy. Interest is well covered, so we haven't got a debt problem in there. And the analysts all like it. Everything's green, so they've been pushing up in the last few months. So definitely a good quality company. And it looks pretty undervalued as well. The analysts say 13% over the next year and a half or so. Again, we think 26 is maybe a little bit low. We're currently trading at 30, a PE of 30. Over the last 3 years, we've averaged 30 as well. 10 years, we've averaged 30. 20 years, we've averaged 30. So I think they're discounting it a little bit more than is necessary there. So if we put the PE up to 30, keep the analyst estimates again, then we get a return of 29% over the next year and a half. Which pretty good from a smallish company. What was it? Yeah, 38 billion or so. So I think that class is a medium size in America these days. So definitely we think there's a good chance it's undervalued. From a TPI point of view, it's in an uptrend. The weekly has just tipped over. It's tipped over recently as well, went up a bit and then has gone down a bit. So turning so quickly, I sort of worry a bit. So if we look at the chart, we can see that actually from its dividend, the earnings were great. So from its dividend, it's really just gone nowhere. So I'd really want to again see it break out of that downtrend that it's in and go up, which is again what the TPI is telling us it's likely to do. Obviously had a big dip around there. Want to see what that is as well. But yeah, for a company I've never heard of, then it's quite an interesting one. Invent is another one. This makes basically machinery for data centers. So it will if you look down the bottom in here, it makes electrical components. It says it's a very dry description of what it does, but I did some research on it, and it does things like cable management solutions, it does enclosures, it does electrical connections and protection solutions. So all the things you need to see in a data center. Data centers are pretty hot at the moment because everyone's spending so much and putting so many new servers into data centers for AI and for AWS and Azure and services like that to grow. So I tend to look at these because I'm a nerd and a geek, and I develop things as well. It's always of interest, and I have a sort of more in-depth understanding of the industry as well. So it's an interesting one. This one's actually a UK company, which you don't see very many of those in sort of our list a lot of the time because they tend to be pretty undervalued on the London stock market. But it's got a listing on the US stock market. Again, high quality. It's had good momentum recently. So just at initial glance, that looks pretty good. The earnings per share, again, looking great and looking like a slight dip this year. Not sure what that is. I couldn't find any information on that because it's not massively covered by people out there. But again, it's coming back to growth this year. The PE ratio or the PEG ratio is under 1.5, so great. Looks like it's going to be some great growth. The analyst estimates Company health score, I hadn't spotted that actually. I'll look into that a bit more. 3 is pretty poor, but I'm quite surprised because actually the rest of it, the analysts are all forecasting it's gonna go up. The PEG score's great. The quality markers here are pretty good. I mean, selling technology solutions isn't a massive, you've got to be pretty good to get sort of a return on equity of 18% in that sort of business because the margins aren't huge some of the times. Dividend is well covered, as you can see here, 3.4 times the free cash flow, and they are generating cash as well. And their debts aren't too bad, but they're serviceable at 7 times interest coverage. So yes, this is a quality company. From a valuation perspective, slightly less exciting than some of the others out there. We're looking at the analysts think that it's going to turn over a P of 24. And it's going to drop a bit this year and go up by 10% next year. So they're forecasting a 6% rise. We think again the P ratio is potentially a bit low. We see, the analyst estimate thinks it's going to be 27 at the end of this year. So why would it dip down when it's growing again after that? So if it does keep that 27, then you could see a 17% return. So whether that counts as undervalued or not, I think it's very much on the borderline there. So I might actually pass on this stage and say answer to question 2: is it well valued? Is probably a little bit overvalued, or probably not a little bit, not quite enough of a potential reward in there for us to go forward. But if we just again take a bit of a glance at the TPI, we can see the stock price in a very nice uptrend. It's all greens, triple green on there, so that's always a good sign. So from a short-term buy point of view, that could be a good bet. The nice thing about this industry as well is the bellwether here is Nvidia, which reported last night stellar growth in the last quarter's returns, and they're forecasting that that's not going to change anytime soon. So the demand for this company's products are going to be there for at least a year and a half, and possibly longer than that. Three more, go through very quickly. PGR, I mentioned this in the members group, I think it was last week, as a potential stock to watch. Very high quality. It's an insurance company over in the US, just general liability insurance company. They have a great earnings growth in there. They're forecasting 72% next year, which caught my eye on this. Because of the rise and the analyst expectations, it's got a tiny PEG ratio of 0.2. So it basically saying that they expect the company to grow very, very quickly. And you can see that actually from 90 days ago, the analysts have adjusted their estimates 30% upwards, and also their revenue estimates as well. The return on assets, okay, you tend to look at return on equity for an insurance company, so it's 19.2, so that's pretty healthy. They're again another free cash flow generation machine. That just sort of, last year they were just pumping the money out of their company, and their debts are all manageable. So that's not a problem whatsoever. From a valuation perspective, the stock is, we think, undervalued. Analysts think it's going to grow by 12%. Again, we take issue with their PE ratio that they expect it to be about 19. The stock hasn't traded. Its 20-year average is 19, but for the last 10 years, its average is 25. Last 3 years, it's 49. So if we just put in a 25 PE ratio and a 27 in our cases, we can see a potential 45 or 57% increase over the next couple of years. If it just hits 18, which is the 20-year average, then we'll still gain 5%. So this one, to me, I mean, I said it last week in the members group on Facebook, where this looks like a fantastically valued company and a good opportunity. So the answer to question 2 is yes, definitely. It's looking good on the valuation. From a TPI perspective, yes, it's looking like it's got a great uptrend. It's just tipped from oversold but going up to oversold and in the sell zone here, and the daily has gone down a bit. So I wonder if we look at the chart on this, we can see, yeah, it's come down a bit. So again, technically probably broken its uptrend slightly there, so we'd probably look to see it coming up, which hopefully the TPI will push it up in the next few weeks. It's just had earnings, which I think people expected it to be high, so it's probably just topping out at the moment and waiting for the market to give it some direction, I would guess. I couldn't see anything in my research last week to post the Facebook post that said it could be that there's any particular problems in there. So PGR, probably my favourite of the bunch, I think, that I've found. However, SMI looks really, really interesting as well. Again, this is another post. I posted it in the morning last week, and in the afternoon it jumped by 10%. I can't guarantee that that's going to happen all the time in the future, but from a valuation perspective, very high quality. From an earnings growth, a PEG ratio 0.72, so the analysts think it's going to really go up in value. The returns on capital are fantastic as well. Returns on equity are fantastic. Well covered dividends. Again, it's making cash flow and is covering all the debt. So yes, a great quality company. Is it overvalued? It probably would be from its peak. It has dropped since then, but now is about the time when it starts going up. It was up 10% earlier on, but I think it's dropped down, and it might even have been losing today right now. But we see a potential undervalue there. The analysts are valuing it at 31 times earnings, and it hasn't been. With the current market and the current position it's in for the AI production, then we think 35 or 40 is a much more applicable number for there. So if it was at 40, you'd see a 56% rise. If it's at on the lower schedule, then we're seeing a 36% rise. And again, it's in the green for the TPI, so good time potentially to buy on there, and it's going up. So it did break through the holding pattern that it was in before, so it looks good. And then lastly, we have Trex Company, which I had heard of before. They make outdoor products for gardens, again over in the US and internationally. Very high quality company out there. They're not huge. They're 10 billion or so, which tends to be sort of the limit. Maybe I'll look a little bit lower than that sometimes, but tends to be where I look for. Earnings per share last year was 1.9, and it's looking to go up by 20% and 12%. PEG ratio is under 2, brilliant. The returns on assets, capital, and equity are fantastic. Again, yeah, it's generating some free cash flow for us and is covering the interest. Be interesting to see that number. I'll look a bit more into that. And from a health score, it's got a score of 9 out of 9, which you don't see very often, but I picked this up from a Petrosky score screener. And the analysts like it, and we like it too. So yes, it's a quality company. Is it undervalued? Yes, it probably is. The analysts think it's going to rise 15.5% on a PE of 40. We think the PE is probably underdone slightly. It's currently at 47. It's been 47 for the last 5 years. So why would it go down when it's going up in value and you're seeing 20% returns? So we see a potential of 35% out of that if it's that undervalued, and it has been up there in the past in 2022 or at the end of 2021. Could have been something to do with COVID and everyone being at home for the previous year, but it's climbing back up again. And then from a TPI point of view, we're currently just swinging in the last week or so into a buy zone. So it could still go down, but it's looking likely that it'll start swinging up again. And looking at the chart for Trex, it has been in a down trend. So look at it breaking up is where we're. That's what I'd be looking for, definitely. And that's the the stocks that I've been looking at sort of today. So what I'll do, probably do another roundup in about a month, and let's see how these ones did. The market is pretty toppy right now. When we do our large stocks or customer inspiration um, screener, there's not an awful lot on it, because we've got some pretty important. Well, there's less on there. Oh, there's more on there than I thought. So some of the stocks have dipped down a bit. When you start looking at an upside of maybe a little bit more, we tend to look at 15%. You tend to see less and less stocks appearing in the screen. Again, there are more on there than I thought there would be. So that's an interesting one. The TPI on a lot of these is red though. There are a lot fewer that we'd actually say are in the buy zone right now. But that's what we're looking at the moment. Is there's not an awful lot of stocks at a reasonable price, and I spent a couple of hours just sort of going through my screeners earlier on, effectively looking at some of these, either the standard stocks, my stock ones that we give you guys, or I've got a Petrovsky one which I've set up, which effectively gives us anyone with a Petrovsky score of greater than 8. That's where I picked up Trex, MRM, MLM, and Champion X for. So we're not seeing a huge amount out there at a decent valuation. So what that says about the market, whether it's going to carry on going up or whether it's going to go sideways or whether it's going to take a dip, that's an interesting one. I think there's probably more in certain areas, like the tech area just seems to be steaming ahead and will carry on because of the spend going on. The other areas, I think the interest rates will probably be the biggest, have the biggest effect on those other sectors. Are there any questions? Because I've been rabbiting on for an hour and a quarter now. Probably about 10 minutes for the initial, but for the initial mess around with Restream. Are there any questions that anyone's got? Is anything unclear, or do you want me to go over anything in particular? If that's the case, I will say thank you very much for watching, and we'll do the same thing in a month or so. Hans Henrik normally does the webinars, but I'm doing this one, and I'll sort of come in regularly on the English ones in the future. Unfortunately, my Danish isn't that great, so I can't do the Danish ones, but certainly do round up and keep a track on these of how well they're doing. And see what the performance is like, and we'll try again next month and come up with another load. But thank you very much for your attention, and we'll practice on the Restream and work out what went wrong earlier on, and we will see you soon. Thanks.